Hello and welcome to my channel Blue Chip Finance. In this video, uh, we will discuss about degree of operating leverage, which is topic of project analysis that is a part of corporate finance. And it is the last part of project analysis. After this, we will discuss about the next chapter, that is WACC, weighted average of cost of capital. So degree of operating leverage, or simply DOL, is a financial way to ascertain the change of operating income due to change in sales. There are different formulas available to calculate degree of operating leverage. As you are seeing here, uh, uh, I gave here four different formulas of calculation of degree of operating leverage. But there are many other formulas are also given in different books related to the calculation of degree of operating leverages. But most common formulas are given here. So as you are seeing, that first formula is 1 plus fixed cost including depreciation divided by profits. Another one is that percentage change in earning before interest and taxes, EBIT, divided by percentage change in sales. Third way to calculate is contribution margin divided by operating income. And I hope that you are good familiar with the calculation of contribution margin. That is our topic of managerial accounting. And fourth way is to calculate degree of operating leverage is sales minus variable cost divided by sales minus variable cost minus fixed cost. So that is enough to know about degree of operating leverage, and the remaining you will get through the solution of different problems. So let's start first question of today's video, that what is the degree of operating leverage when sales are $20,000 on selling of 100 units, no depreciation, fixed costs are 2000 per year, which means that depreciation is not included in this fixed cost, and variable cost are 60 per unit, whereas machinery cost is 2000, having zero scrap value, and life of that machinery is 4 years, and depreciation method is straight line. So straight line depreciation method should be adopted. So first of all, we get data from this question, that first of all, sales is 20,000, non-depreciation fixed cost is 2000, machinery cost is also 2000, life of machinery is 4 years, scrap value is 0, and variable cost is 60Q, and unit sold equals to 100. So first of all, we will calculate depreciation. Under straight line method, depreciation is equals to cost minus salvage value, residual value, scrap value, divided by life of machinery. So cost is 2000 minus 0 divided by 4, and your depreciation is 500. Now second important thing is the calculation of profits. So profits, as you know, that equals to revenue minus total cost, and or we can say that total revenues minus total cost, and total cost is equals to variable cost plus fixed cost plus depreciation. And when we open the formula, it will become revenues minus variable cost minus fixed cost minus depreciation. So profits equals to revenues are 20,000 variable cost 60Q and Q or units sold are 100, so 60 multiplied by 100 minus fixed cost is 2000 and depreciation is 500. So after the calculation of this equation, profit will become 11,500. Now we come to the calculation of degree of operating leverage, and here we are going to use the formula 1 plus fixed cost including depreciation divided by profits. So 1 plus fixed cost is 2000 and depreciation is 500, so total will be 2500 divided by profits 11,500 and degree of operating leverage will be 1.217. And if we calculate degree of operating leverage through another formula, that is sales minus variable cost divided by sales minus variable cost minus fixed cost. So sales is 20,000, variable cost is 6,000, divided by 20,000 minus 6,000 minus 2,500. This fixed cost must include depreciation, and DOL will be 1.217. And third formula here we are going to use is equals to contribution margin divided by operating income. And contribution margin, as you know, that it is equals to revenue minus variable cost is equals to contribution margin. So sales or revenues are 20,000, variable cost is 6,000 and your contribution margin will be 14,000. And when we subtract fixed cost including depreciation out of contribution margin, your result will be operating income. So operating income will be 11,500. So same result we can get from this formula too. 14,000 divided by 11,500 equals to 1.217. So here is one practice problem for you which is taken out of your book of corporate finance, Brealey Myers. What is the degree of operating leverage when sales are 30,000 on selling of 80 units, non-depreciation fixed costs are 3,000 per year and variable costs are 50 per unit, whereas machinery cost is 3,000 having zero scrap value and life of that machinery is 4 years. Straight line depreciation method should be adopted. Next question is that you estimate that your cattle farm will generate 1 million of profits on sales of 5 million under normal economic conditions, and that the degree of operating leverage is 6.5. What will profits be if sales turn out to 3 million, and what if they are 6 million? So here there is another way to look the degree of operating leverage, that how can we use this to calculate the percentage change in profits. So percentage change in profits, if you have two things, one that you have percentage change in sales and another one is degree of operating leverage, then you can calculate your percentage change in profits. So if in the first case your profits turn out to be 3 million, so what is the reduction? Reduction is 2 million. Your profits were 5 million in the base case, but now your profits are 3 million. So what is the difference? Difference is 2 million. So 2 divided by 5, 5 is your base case profit. So 2 divided by 5 multiplied by 100 equals to 40%. So that is your percentage change in sales, and your degree of operating leverage is 6.5. So simply 40 multiplied by 6.5 equals to 260%. And when your sales turn to 6 million from 5 to 6, from 5 million, then percentage change will be 1 by 5 multiplied by 100, 20%. And simply just put this 20% in percentage change in sales multiplied by 6.5, that is degree of operating leverage, and 130% increase you will find in your profits. And in this case, to 60% reduction in your profit. Here, another problem is that you estimate that your cattle farm will generate 1 million of profits on sales of 4 million under normal economic condition, and that the degree of operating leverage is 7.5. What will profits be if sales turn out to be 3.5 million, and what if they are 4.5 million? Another way to look degree of operating leverage, that a project has fixed cost of 2,000 per year, depreciation charges of $1,000 a year, a revenue of 12,000 a year, and variable cost equal to 2/3 of revenues. A is that if sales increase by 20%, what will be the increase in pre-tax profits? B is that what is the degree of operating leverage of this project? And C is that confirm that the percentage change in profits equals degree of operating leverage times the percentage change in sales. So first of all, in first case, if sales increase by 20%, what will be the increase in pre-tax profit? But before solving this, first of all, we get the data that fixed cost is 2,000 a year, depreciation is 1,000 a year, your revenues are 12,000 a year, and variable cost equal to 2/3 of revenue. So 12,000 multiplied by 2 by 3, and variable cost is 8,000. So in base case, what is your profit? Profit equals to total revenues minus fixed cost minus variable cost minus depreciation. So 12,000 minus 2,000 minus 8,000 minus 1,000 equals to 1,000. And if your sale increase by 20%, what will be the increase in pre-tax profit? Before this increase, your profits are 1,000. So if sales increase by 20%, and after increase of 20% in sales, your sales turn to 14,400. And fixed cost, as you know the basics, that fixed cost is independent to number of units. So there is no change in fixed cost, and simply the depreciation is also independent to number of units. So depreciation, there is no change in depreciation, but variable cost is dependent to number of units sold. So if there is an increase in 20% in sales, then 20% increase will be in variable cost. So sales will be 14,400 and variable cost will be 8,000 multiplied by 0.20 plus 8,000 will be 9,600. So now your profits will be 14,400 minus 2,000 minus 9,600 and minus 1,000 will be 1,800. So what is the change in profit? Change in profit is 800 in amount, and in percentage change it is 80%, because 800 divided by base case profits are 1,000. So after increase the change is 800. So 800 divided by 1,000 multiplied by 100 equals to 80%. And now we calculate the second part of this question, that what is the degree of operating leverage of this project. So degree of operating leverage equals to 1 plus fixed cost including depreciation divided by profits. So 1 plus fixed cost are 2,000 and depreciation is 1,000. So total fixed cost is 3,000. So 3,000 divided by 1,000, that is your profit, equals to 4. In C case, confirm that the percentage change in profits equals to $$ times the percentage change in sales. As we calculated manually here, that percentage change in profits after the increase of 20% in sales was 80%. So now we confirm through the second question's formula that percentage change in profits equals to percentage change in sales multiplied by $. So in the second step we calculated $, which is 4, and in the question it is given that 20% change in sales. So 20% multiplied by 4 equals to 80%. That is equals to to this manual way of calculation in percentage change in profit. So this third question is, in fact, it is very important to understand degree of operating leverage, and in different aspects how can we use this degree of operating leverage in the calculation of percentage change in profits. So one another problem, practice problem, is given here, which is taken out of your book, Corporate Finance of Brealey Myers, that a project has fixed cost of 1,000 per year, depreciation charges of 500 a year, revenue of 6,000 a year, and variable cost equal to 2/3 of revenues. If sales increase by 10%, what will be the increase in pre-tax profits? What is the degree of operating leverage of this project? Confirm that the percentage change in profits equals DOL times the percentage change in sales. So just solve these three problems and all previous problems given in previous videos, and practice these problems as much as possible. In the next coming videos, we will discuss about the fourth topic of corporate finance, that is weighted average cost of capital. Till then, Allah Hafiz, take care of yourself and other persons around you. Thank you.